Today I had the pleasure of interviewing the trader behind Darwin SUG. Ben is predominantly a breakout trader, but also diversifying into mean reversion strategies, all of which have delivered exceptional performance recently. In this exclusive interview, Ben shares some detailed information about those strategies, including how he uses filters and timed exits to dramatically improve performance. He also goes into great detail about his strategy development process. He explains why the number of trades or the sample size of backtests is critical to developing a successful strategy. I hope you enjoy it as much as I did. So it's my great pleasure today to speak with Ben from Canada, who's the trader behind Darwin SUG. Hi Ben, how's it going?
Great, how are you?
Yeah, I'm really well, thanks. So I've been looking at your chart of SUG on the platform and noticed that you've had some really excellent performance lately, but really performance has been consistently good right throughout your Darwinex track record since 2018. So I'm guessing that you were probably trading for some time before you came on board with Darwinex. Would you mind telling us a little bit about your background and also your trading journey so far?
Sure. I might have to remind you that we knew each other before I had even heard of Darwinex.
We did indeed, yes.
And back then, you didn't work for Darwinex, but I think you were affiliated, and you were the one who introduced me to Darwinex.
Indeed, yes. And I'm glad you came on board, and I'm glad you're performing so well.
I have emails dating back to February 2018.
Yeah, and I was looking through those myself as well, just to sort of catch up with your, because we talk also about your sort of, your approach to backtesting and so on, didn't we? We shared some information together. It was a really useful time, actually.
Yeah, it was pivotal for myself also. We had some conversations about trading in general.
Yeah, because we're both very much into the process of rigorous backtesting and so on, and so we were brothers in arms really in terms of sharing information about that. I remember it well.
And I feel like you went on to create a school, and I feel like I got a free education out of
it. Well, thank you.
Right before you opened your school.
Yeah, no, that's cool. So what's happened since then, Ben? Because we haven't spoken for quite a long time.
Yeah, so I have been trading since actually around 2007 I started trading.
Right, okay. Quite a long time then.
Yeah, I started trading stocks, and I didn't trade that for very long, but I got a lot of ads about the 24-hour market of the Forex, and I kind of got sucked into that. And first thing I learned about was MetaTrader, and being a programmer, I found it kind of neat that I could just program my own stuff. It had its own language, so I began tinkering with Forex from around 2008, and it kind of took more and more of my time as time went on.
Now, I remember, Ben, that when we used to exchange emails, you gave me a bit of your background then, and you'd actually been a professional poker player. Is that right?
That's correct, yes.
Did you find that, there was any crossover between that and trading?
Absolutely. Yeah. I don't know where to start. So psychologically, definitely you've got the ups and the downs. There's a lot of math and statistics that I'm paying attention to. Yeah, I find them both similar.
Right. Okay. And so, how did your trading develop then? Once you'd started to learn how to code different rules into an algorithm, where did you take that, and what kind of trading strategies evolved?
So I remember that one of the first strategies that I coded was actually kind of complicated to do it. It was a trend line break strategy. Over a 10-year period, it had 25 trades, and it looked really great.
Well, you know what I think about the importance of sample size, and you do these days as well. So it's interesting. Just 25 trades over 10 years. So I guess we'll talk bit about sort of sample size and so on later on, because I know it's one of your key areas now.
Right. Yeah. So eventually around 2012, someone posted some code for a contest winning EA. And it was basically a Donchian channel breakout. And I kind of took that and put my own twist into it. And that's actually been the bulk of my trading ever since.
Wow. Okay. So this very first strategy that you sort of came across.
Well, the first good one.
Yeah. Okay. But over all those years, really, that's still the foundation of what you do today.
It is. Yes.
Okay. All right. Well, I know that you're going to talk through a little bit more of the detail around that and sort of maybe show us on a chart later on. So let's save that for then.
Sure.
Now, I've been, as I said, taking a look at your Darwin, and I can see that you score extremely highly on the risk-based metrics on the platform, especially the risk adjustment and the loss aversion investable attributes. So maybe you could tell us a little bit about why you think, you score so highly on those.
So loss aversion, probably because the majority of the trades are the breakout style with a tight stop loss and a far away TP. So we're not holding losses for very long, and the losses would be much smaller. I think that's kind of how that stat works. My loss aversion score might actually go down as I add more mean reversion strategies.
Ah, okay.
That's a possibility, which I just started adding them, but it hasn't seemed to affected it yet.
Right. Okay. So you're looking to diversify then in terms of the strategies you're using.
Always looking to diversify. Yeah,
Okay. Great stuff. All right. I guess you still consider yourself primarily and foremost a breakout trader. Is that right?
I am. Yeah, I'm a breakout trader, striving to diversify.
Yeah. Cool. Okay.
What was the other stat you said I was doing well in?
Risk adjustment.
Risk adjustment. Yeah, that is high. So all of my strategies are based on the ATR. So they're not swinging around too much.
So I guess you adjust your position sizing based on what the volatility of the market in that particular instrument is.
Yeah, and the calculations of Darwinex seems to like that.
For sure, yeah. So just for any listeners that aren't aware, so the risk adjustment investable attribute effectively gives an indication of how often the Darwinex risk manager has to intervene in terms of passing risk through to the Darwin that investors can invest in. And so the higher the score there, it means the less that the risk manager has had to intervene. So I guess, Ben, the fact that you're taking account of volatility in your position sizing, it just basically means it doesn't have to intervene and change things very often for you.
Yeah, I think that's right, and also I'm not increasing the size if I take some losses to try to win it back.
So there's no martingales there.
No way.
No. Good. Similar to me. Good. Okay, so talking a little bit now about investment and your ability to attract investor capital to your Darwin. I can see that, third-party investment has been increasing nicely over the last 6 months, and that looks to be linked to your recent performance improvement. What would you put this improvement down to? And, was there anything fundamental that you changed in your strategy to produce that improvement?
So I don't think I suddenly became a much better trader recently. I am gradually becoming a more skilled as I study and I think up new theories and attempt to prove or disprove them, as well as reading and rereading books and grasping them a little better each time. I've recently gotten significantly more picky about which walk forward tests I trust enough to go live, but I doubt I will get another 20% month anytime soon. This month I was Very lucky. I think the market's just moved a lot, and that's when my systems make the most money. I also recently found a filter that I really like, but I was expecting maybe a profit factor increase of about 0.03 or 0.04 on any of the signals I employed it to. That's including the new walk forward selectiveness. April was just really lucky. As far as the investors coming in now, my guess is that the Darwin new high increases the profit to the drawdown ratio. And we're 5 years old now, so hopefully we're attracting some wiser money that won't just make like a tree at the first sign of trouble.
Yeah, so investors obviously have their own criteria that they're looking for, and you made a good point there. You've got an established track record now, 5 years, and so for some investors that's an important attribute. And so I agree. I think you're possibly opening the doors for a wider selection of investors being attracted to the Darwin now. So in addition to the third-party investment growing nicely, as I've said, and that's just over $500,000 US at the moment. I've also noticed you've got 850,000 in seed capital investment from the monthly DarwinIA competition, which is really, really impressive. So well done there. Can you tell us how you find DarwinIA generally, and do you think that the monthly competition and the competitive angle to that has motivated you to become a better trader?
Well, yes, DarwinIA is what kept me loyal to Darwinex for sure. DarwinIA is free money. I don't know what else to say. It's great. It seems to give the right incentive to traders. It should be attracting good traders, and bad traders aren't winning anything. So and that's what Darwinex wants, and good traders are going to benefit from that. It's just free money for them.
You made the point that it's what kept you loyal to Darwinex, and I guess you're talking there about maybe at a time when you didn't have so much third-party investment, and so it was something that motivated you to carry on, with your sort of your trading endeavors. And so now that your third-party investment is growing, I guess that might eventually get to a point where that exceeds DarwinIA, and DarwinIA will become less important, but it got you through that stage of your trading journey to sort of push you on and get to that point where you're now being much more successful in attracting third-party investment, which of course is exactly the purpose of DarwinIA. That's why DarwinIA exists, to bring traders along. So I'm really pleased that you see it in that way.
I think I made a post maybe on Reddit. This was back in 2018 or 2019, and I just not affiliated by Darwinex or anything, but I chimed in somewhere, and I wrote a little thing about how good it is, and I got into an argument with a guy. I had someone from Darwinex eventually contact me about that, and they asked me kind of survey me on why did I like it, and what kind of trader am I.
Okay, oh, that's cool. It's good that we follow up on these things.
Yeah. But anyways, I'm a big fan of DarwinIA. I mean, it's just it's free money. It doesn't make any sense to not be.
Great to hear. So let's now turn our attention back to your trading strategy then, Ben. So, you gave us an idea that, primarily you're looking at breakouts, and you mentioned Donchian channels. Maybe you could share your screen and just talk us through sort of step by step the kind of things you're looking for in a chart, or your algorithms are detecting in charts, and how you sort of go about trading your primary strategy.
All right, so this is kind of how it works. So a Donchian channel is basically taking a recent highest high and a recent lowest low. So maybe on this chart, perhaps the distance from the highest high to the lowest low is too big. So maybe we don't have any trades on there yet. Like it might just be too big to have a signal. So as time passes on, maybe at this point we have this tighter period of consolidation, which would trigger a signal, and then we would have a buy stop order placed here and a sell stop order placed here.
Okay, so I see that you're on a 1 hour chart there.
Yeah.
Is that typically the sort of time frame you focus on?
Yes, 1 hour is kind of, and one of the lowest. I think it's currently the lowest, although I have had put on 15 minutes, and I think when I first started it was actually M30, but right now I'm using H1 for the most part, H1 and H4.
Is that sort of, do you find that if you go any lower, charges tend to be too big a proportion of the profit, and is that sort of the reason you don't go lower?
Well, yeah, charges, exactly, slippage.
Yeah, okay.
Also, but it's more than that. It's also that there seems to be a lot more randomness. It's harder to find an edge on those lower time frames.
Yeah, okay. So you're looking basically for as tight a channel of consolidation as possible.
Right. Well, yeah, that's a setting. So
yeah, sure.
Some height of the Donchian channel is tolerated, a certain height. Yeah. And when I first got the code back in 2011 or 2012 or whenever it was in pips, and since then I've of course changed everything over to ATR so I can cross over markets easier. And I added a lot of my own little twists here. We talked about this once. I have a timed exit.
Yes.
And when I do my optimizations, I actually have an exponential function. So if the timed exit is set from 1 to 10 bars, it's not actually from 1 to 10 bars. A 2 would actually be 4 bars, 3 would be 9 bars, and so on. 4 would be 15 bars.
I see. Okay. And that's just if it doesn't reach your target, then you'll decide to close it before that based on this timed exit.
That's right. What else is interesting? I've experimented with a lot of different kinds of filters. I still actually have been using for a long time a moving average filter, but I use it a bit differently. So I'll have the moving average, and then I have an ATR or a Bollinger Band tolerance from it, a certain amount of ATR above the moving average in order to place the stop long, say.
Okay, so that sort of sets the direction that you're willing to trade in.
Right. On some of the signals, some of them are more going to go with the trend, and they use the moving average thing. And some of them actually have a channel within a channel, like this.
Oh, I see. Mm-hmm.
So in this case, it will only go long. This long-term consolidation and a short-term consolidation near the top of the channel. So, or if this is even too big, it wouldn't even place one.
I see. Okay. So it would only go long because price is breaking out of both of those channels. Whereas if it's breaking sort of past the midway mark there, it's breaking out of the top one, but it's still within the second.
Yeah, it's looking for a shorter, smaller period of consolidation near the top or the bottom.
I see. Okay.
Otherwise, it won't place any orders.
Understood. You mentioned before that you have this timed exit then.
Yes.
How often do you find that your trades close because of the timed exit, and how often do they close, because they've reached their profit target? What's the sort of the ratio there?
Oh, so we hit a lot of stop losses because we have a tight stop loss and we expect that. And the ones that go into profit, most of them do not reach the target, and they end up timing out.
Right. Okay. So the majority are timed out. Okay. Mm-hmm.
I would say, yeah, at the moment, the way everything is set up. Yeah. Timed exit. I'm a big fan of those.
Right. Okay. So you mentioned the exponential nature of that. Could you just talk a little bit about how that works? So you mentioned the sort of the 1, 2, 4, 8. How does it decide how long that it waits before exiting the trade?
Okay. So during an optimization.
I see. Okay. Yeah, so it's not something that happens dynamically in production trading. It's something you decide what that value is going to be upfront, and then that's what you trade all the time when you're in production.
Yeah, exactly. The exponential function is used strictly in optimizations. I just find that if you get once you get to say 100 bars, the difference between 100 bars and 101 bars is almost nothing.
Yeah, sure. Yeah. I mean, that's a good principle, isn't it, for any type of optimization, whether it's a timed exit or, indicator periods or whatever it is. Because as you say, with low numbers, the difference is huge, whereas with higher numbers, it becomes completely insignificant.
Yeah, I mean, just 1 to 10 on itself, going from 1 to 2 is 100% increase.
Yeah, that's it. Yeah.
Going from 9 to 10 is a 10% increase.
Yeah. Unfortunately, it's something that MetaTrader doesn't support in its optimizations.
Yeah, not natively, right. But I'm finding that as far as timed exits go, it's even more, it has even more of that effect.
Right. Okay. Interesting.
I also put in a filter that I'm using on some of my signals. I tried the Kaufman's. I'm looking like I tried a couple noise filters, like to try to detect when the market is choppy.
Yeah. So the Kaufman efficiency filter.
Right. But the one I've been using lately that I've been really liking is price density. And I think I got the idea to test both of those from your videos.
Yeah, so I'm a massive fan of the Kaufman efficiency ratio. I think it's a great indicator. But you've gone with price density. Okay, cool.
Yeah, price density with my own twist.
And does that sort of set the direction that your algo is able to trade, or does it say either trade or no trade kind of filter?
It's a Boolean filter.
It's a Boolean filter. Okay, yeah.
Oh, I think I did put in an option to make it directional. It looks like I have some kind of price density momentum setting here. I'm not using it right now. And this was years ago that I put it in, and but recently I've been using it.
Okay, that's all really interesting.
Sometimes I put filters in and then I don't like them at first, but then I just leave them in, and then I come back a few years later and with a new idea on how to use it or whatever, and then I like it. So
Yeah, same here, exactly.
yeah, you know what I'm talking about.
I do, I do. So in terms of, we mentioned a little bit about the process you take. Would you mind sharing, it seems you have this huge emphasis on being rigorous around your strategy development and sort of having a very rigorous backtesting process in place. Could you share a little bit more about the kind of things you do there and the things you're looking for?
Most of my signals at this point in my career are having been walked forward on multiple markets. I think that the size of the sample is really, really, really super important. That includes when I say sample size, not just number of trades, but also the number of bars, in relationship to the number of bars used in the calculations.
Okay. I guess you're talking about the duration of the backtest?
Yeah, I mean, if Pardo talks about degrees of freedom. So, anyways, yeah, I like to make sure that I have a lot of bars and that none of my period lengths are too long in relation to that. Point is, sample size doesn't necessarily mean trades. Most of my sets have at least 1,500 separate signals that can fire off 5 times that many actual trades. So my main EA actually breaks everything up into 5 separate trades at 5 different levels.
So you're scaling into your trades.
Yeah, they're really close to each other. I think that it kind of helps with my slippage as well, and it should help with my slippage as I have more third-party investors coming in.
Yeah, definitely. Doing that kind of thing, scaling in your positions really helps with the capacity that you're able to support with your Darwin.
Yeah, and it is definitely a concern. I have they're all stop orders, so stop orders at recent highs are probably going to be more susceptible to slippage. So I also walk forward on a basket of markets, usually all with the exact same settings.
Right. So you don't try to tune your strategy to stock indices or forex. It's all just one size fits all.
Right. I'm not running the Donchian breakout on any stocks right now. But I do put gold in with some of the major forex. So I'm doing my walk forward a little differently. I keep the top 5 or more, sometimes more, actual sets from each segment, and I look at all of them OOS. and I kind of have to make sure that they're not too similar. If I have two sets that are too similar, I don't really count them as two separate sets. I'm not just picking the top one and going with it, picking the top one and going with it. I want to make sure that all of the top ones are doing okay out of sample for each segment. Does that make sense?
Yeah, I think so. So basically, in terms of the parameters from your optimization, you're basically saying, if there was just one parameter that performed well and the rest performed poorly, then that wouldn't be good enough for you. You want to see that there's a sort of a wide range of parameters that all perform well.
Right, sets of parameters. Yeah.
Yeah, okay. It's interesting, actually, Ben. Your emphasis on sample size is something that I'm really keen about as well. And you might have seen this, but in one of my early videos I produced for Darwinex, I did a study which looked at a completely random strategy. So it decided to buy and sell randomly, not based on any logic whatsoever. And what is very apparent is that for low sample sizes, when you're talking about, somewhere around about 100, 200 trades, very often those random actions can produce what looks like a really good strategy with a really good return. And it's only when you get to much higher sample sizes, so in the thousands of positions as part of a back test, do those random tests begin to fail, and it then becomes more of a case of you get a profit if the strategy genuinely has an edge. And I think that's really important, because effectively what it means is you can trust much more those back tests you perform that are based on a high sample size, and you can trust that, if you are getting good results with those, it's much more likely to be due to an edge that you have in your strategy. Whereas for those lower numbers, you might get good results, but it might just be random behavior that has caused that. So I'll actually put a link to that video. If there's anyone interested in that, I'll put a link in the description of this interview. I don't know if you saw that, or if you've sort of come across the same kind of phenomenon, Ben.
Definitely, I've probably both seen it, and there's definitely a pretty steep drop in the out of sample performance when your sample size is too small for whatever reason.
All right, great. So let's move on then a little bit. And I know that in my own trading journey, there have been several times where my understanding of the markets or a strategy that I'm using have taken a huge leap forward when something just maybe seemed to click into place. Have there been similar moments for you? And what is it that you learned?
Right. So I remember going from a single optimization and with an OS test after, and then reading about how a walk forward worked. That was a long time ago, but definitely really, really super important. Walk forwards are huge, and just doing the one test with one out of sample test, it really tells you nothing. I remember discovering how important sample size is, and I guess that was kind of a gradual discovery, but it's absolutely detrimental to make sure you have enough trades and enough bars.
So just remind us, Ben, what sort of number of trades would you class as being statistically significant in terms of?
So it depends on a lot of factors, but I'm using around 1,500 for my more complicated ones.
Yeah. Okay.
As kind of a baseline. Usually I'm hitting around 2K.
Yeah. So if you ran with a certain set of parameters and they only produced 800, 900 trades, you'd effectively eliminate that and say that it wasn't statistically significant.
Yeah, 8 or 900 signals would produce the 3,500 trades for me. So, and yeah, that's not good enough.
Sure, I would concur with that.
That's getting close. If I have a really simple system, actually, I do have something that I tolerate something a little bit below 1,000 in some of my more simple mean reversion strategies.
Right. Okay. So moving on then, I'm really interested to know what it is that you think distinguishes a successful trader from a non-successful trader.
So I think that one of the things is that the successful trader will ask this exact question. I think this question is really important as an aspiring question to be asking. And I mean, I was asking myself that, and so I read books of proven algo traders with proven track records and see what they all have in common. And every time I go back and reread, I find some nuances, maybe even in that context.
Sure. Could you give us some names, for example, of the kind of authors that you rate?
So I like Pardo.
Yeah. Pardo, of course, is the creator of the whole concept of walk forward analysis.
Right. Yeah. And I like Pardo, and I like who's the guy? What's his name?
Kaufman?
No. He's got some YouTube videos.
Kevin Davey.
Kevin Davey. Thank you.
All right, and then just one final question now to finish off. What are your plans for the future, Ben? And for example, are there any improvements that you either have in mind to make for your strategy, or any improvements you want to make to maybe help attract more investors?
Yes. I am planning a more mean reversion strategies.
Right, so it's the diversification that we mentioned earlier. I'm interested if you were to combine one of your breakout strategies with a mean reversion strategy, what have you noticed in terms of the overall kind of return over drawdown? Does that improve significantly because you're introducing that diversification? So when one strategy is doing well, the other might not be, but vice versa?
It's true that they're mostly not correlated, so there's still a chance that they can both be not doing too well. I wouldn't normally be trading on the same markets. Like some markets are better for breakouts, and some markets are better for the mean reversion.
Sure.
But overall, yes, some, and I think the more I find, the more we can smooth that out. I'm sure there will be more improvements, but it's tough to plan them without some kind of idea or inspiration. On second thought, I want to eventually recreate my trend line signal.
So this is what you talked about at the very beginning.
Yeah, I created one in the past that functioned the way I wanted, but the code was seriously messy, and the results were limited.
I can sort of agree with that, because I've tried to programmatically code a trend line strategy in the past, and it's really tough coding. It's really difficult to do.
So I made this code back in 2012, and I still have a copy of it, and I have a really hard time reverse engineering it, even though I'm the one that wrote it.
Maybe your coding skills are better now, so you should just start from scratch.
Yeah, I think it might be time to check that out.
All right, well, it's been an absolute pleasure speaking with you today, Ben, and it's great to have a proper conversation rather than just discuss things over emails like we have done in the past. Just one final thing, if anyone has any questions or wants to get into contact with you, are they able to do that, and how should they go about it?
So you can check my janky blog website, outdated, but you should be able to find an email on there for me, bentra.ca.
Okay, so I'll put a link to that in the description of the video as well.
Thank you.
It's been an absolute pleasure, Ben. Thank you for your time. It was brilliant to eventually speak to you, and I've got a lot from that, and I'm sure our viewers will too.
The pleasure is all mine, honestly. Well, back when we first made contact, if you would have told me one day we'll be doing an interview because I won I did well, so well that Darwinex actually wanted to interview me, I wouldn't have believed it.
Well, it's been great to have you on, Ben, and you are a great trader, so keep up the good work.
Thank you very much.
For now.
Bye.